This is going to be the ultimate first-time home buyer's guide, whether they're looking to buy a condo, a freehold town, a detached. I'm going to go through every single step that I've noticed that everyone goes through, all 25 of them, so that you can reference each and every single one. So this is going to be an extra long podcast, but it'll be the ultimate guide for buying your first home. So make sure you stay tuned. Promise you, it'll be worth it. Good day, Toronto. Welcome to this month's episode of the Prime Properties TL podcast. I am going to record a very, very long form format, basically that serves as the ultimate guide for anyone who's looking to buy their first home from step 1 to 25. I'm actually pretty sure I have 26 in there, which will be like a sample one of how to calculate all your finances and everything. But the idea here is to answer every single question that you may have as a first-time home buyer, plus any other small things that you may not have thought of, because it's a really awesome kind of thing to go into get your first property, but at the same time, it's a lot of things going on, right? So I'm going to break it all down and have all 26 steps in the timestamp. So if you're watching this on YouTube, you're going to see, you can click on each and every single one of the title, see which one works for you. So that's a little bit interactive. Now, if you're listening to this in the car, I'm sorry, there's no way for me to do this for you to have timestamps without me kind of listing everything and the time frame on it, right? Which still is probably not good, especially if you're driving. So the idea here is you can listen to the whole thing and get an idea of looking for a first home, or if you're just kind of looking for very specific niche kind of items when during your journey, you can click on that as well, right? So hopefully you guys enjoy this. It's a very long laundry list of kind of what's going on, but I have it here on the right hand side. So I'm going to start off right now. The first one of 26, it's getting started, right? So the idea here of like step one and getting started is when you think about buying a home, there's a lot of things that go through your mind, right? And it's a really, really big decision. So congratulations on thinking about it and also being, financially capable of doing it. That's the first thing. Just know that, when you get started, it's going to be difficult, especially in the current Toronto real estate market right now, where it's a seller's market. So this is being recorded in like mid-October, give or take, of 2021. And a lot of people always come to like, where do I start, right? I mean, obviously the first thing is you want to see what's available out there. I want to check your financing and all that. And all of that is going to be in the next few little steps. But the whole reason why I'm kind of having this kind of like a, what do they call this? Table of contents, right? Is so that you understand every single thought process along the way, right? So I'm going to give you kind of my topics that I have. And this is kind of what getting started, right? So first we're going to have, this table of contents. Then the second one is actually a really good question a lot of people don't ask themselves, which is, should you actually even buy, right? That's number 2. Number 3, we're going to go into some of the financing and closing costs. Number 4 is the approval letter. Number 5, we're going to talk about your down payment, whether you want to do minimum down or 20%. Then we go on to talk about 6, which are RRSPs. 7, your benefits as a first-time home buyer. Number 8, this new first-time home buyers incentives that they put in. Then you got 9, pre-con versus resale. Then you got 10, which is your current living situation. And then 11 is actually when we get to starting a search, because there's a lot of due diligence steps before you actually start looking, because when you start looking, you don't have a plan, you're going to get burned by the market. So then 12, you got what should we buy, which is where I think I'm going to spend quite a lot of time there, because I want to break down all the components of it and kind of the minutia of kind of getting the deal done. Then we got 13, which is getting the offer part. Then the 14, I'm going to talk about kind of the competition, which follows up with 15 about whether you should make a bully. Then we talk about conditions in 16, 17, which is financing and home inspections and status certificates. Then you got 18 is what do we do after we found the unit, right? Because that's kind of the hard part. Then we got to finish it up. Then we got 19, we start talking about mortgages, variable versus fixed and stuff. 20, we got to talk about lawyers. Then we got 21, which is insurance. And then we go more about mortgages and going on this list. And then we got closing, and then all the extra pieces, which is 24, 25 is what investing and how do you mobilize the Smith maneuver. And then we calculate a sample calculation for you if you're watching this. So again, if you're listening to this in your car, I apologize. You're not going to see some of the visual components, but I'd say 80% of it will be kind of audible. It will be understandable in audio form. Okay. All right. So let's go to number 2. So the question I always pose is, should you even buy, right? There's this whole idea of like buying versus renting, and everyone always talks about how, home ownership is great. It's very kind of like, white picket fence is a dream out there, right? And I think it's like 65% of people in Canada actually own their property, which is fantastic, right? But I'll give you a little bit of story of mine. Like the first property I bought wasn't actually even for myself to live in. It was actually a rental, right? So I believed the concept of owning real estate as an asset being very, very good, but I actually didn't buy a home for me to live in because I didn't want, well, one, I didn't need the space, but two, I had better use of the money because I knew how to invest it, right? So that's kind of a question that I would always pose to the person, like, why are you buying? Because a lot of people, they're like, oh, I should buy because for the sake of buying. But there's many instances where buying actually doesn't make sense, right? And people always say, oh, you got to get into the market and all this stuff so that doesn't outpace you, which is kind of where we have the FOMO, fear of missing out kind of scenario going on. And you really got to watch out and kind of ask yourself why many, many times to see if this decision is actually right for you. Like I've actually talked a lot of people out of buying it because it doesn't make any sense. Because sometimes they're like, oh, I was told to buy this, right? It just makes sense to buy this, right? Or even sometimes in like our Asian culture, it's like, oh, your parents tell you to go buy something, they'll give you the down payment. Granted, first world problem, right? But the idea is sometimes it's not right for everyone, right? So let me give you an example, right? Like if you're traveling a lot, why do you need to buy a place? Just rent, right? You want that kind of flexibility and mobility because especially like a consultant flying around to different places, assuming business flying goes back to normal, it doesn't make sense for you to buy it, right? So that's why you got to ask yourself why many, 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 many times, right? Now, I'm going to give you the pros and cons to buying and selling, right? Like there's no right or wrong. I've had this debate with a lot of people. And despite me being a realtor and having a lot of investment properties and stuff like this and owning my own home, I actually think renting makes a lot of sense in today's current market environment. Let me give an example why. If you're renting right now, especially say like you need to be downtown and you're working downtown and you want to be able to walk to work, the ability for you to buy something if you don't have the down payment is very difficult, right? You have to do 5% down because then now you say maybe paying $1,500, $1,600. That's a bad. Let's say you're paying $1,800, $1,900 for a one bedroom right now, and you got that pandemic pricing. For you to go buy something, if you don't have 20% down, and this is something I'll go into later, you're going to increase your expenses to almost like $2,800, $2,900 a month, which is almost like adding another $1,000. And that could make or break you. So, in those instances, if you want kind of that flexibility in a lifestyle, you may not want to buy something. You could just rent something. And the idea, what a lot of my younger clients I'm doing right now is just go to the outskirts where you can buy something and the rents do cover the expenses and you just continue renting where you are and then buy an investment property, right? And that becomes your first property. That's something similar to what I did. And you want to do that because if you're in a building where you're under rent control, so anything that's built after built before 2018 of November, the owner is not going to be able to increase your rent more than 1% to 2%, depending on whatever the provincial guidelines are, right? So the idea to stay rent and the stay renting where you are in downtown and continue renting there while the prices are kind of fixed in somewhat, right? And then you go rent somewhere else, then you have your money put to work for you, right? So in those instances, buying your first home for you to live in, quote unquote, doesn't make sense, but buying an investment property does. Another way to think about this is like, hey, if you're living at your parents' place and you have a very comfortable lifestyle, you don't necessarily need to force yourself to go downtown or wherever to buy something. You can also put that into investment, which a lot of my clients are doing as well, right? Another option is like, if you have like too many obligations right now and you just don't really want to get it, like own anything, then you should just not buy anything for the sake of buying something. Just take that money and you can invest it in something that's actually going to do well as in terms of investment, like do well for you or in terms of like return on investment as well. Now, granted, I'm a little bit biased because real estate has done well for me. So I would say invest in real estate, which is why I gave you those two examples earlier. But if you don't like the idea of home ownership and you just don't want to deal with tenants, then yeah, put in like the stock market, ETFs, NASDAQ, whatever, right? Like S&P 500, you just do you, right? So that's why you really have to ask yourself, like, why? Why am I buying this home? Why am I buying? Because it's a big commitment, and I wouldn't say you should be forced into owning, because that's kind of what I had before too, where it was like, oh, you shouldn't buy your own home because that's kind of go to school, get good grades, get a good job, buy a home, start a family. It's like I was very like against the grain, and I actually refused to do that. So I had it was a very long time before I actually bought something that I personally lived in, right? So it didn't make any sense for me, but it worked out, right? But you just have to understand the reason why you're doing it, right? Like if you're just not buying it to be contrarian and then you do nothing with your money or you have nothing saved, then that's not being smart per se, right? From like, being smart with your money kind of idea, right? Now, if you're kind of looking to buy something, you also have to think about where you're going to buy, right? Are you buying in the suburbs versus downtown? And if you are going to buy in those areas, are you doing this because it's too close to work or you may be close to friends? Like you really have to ask those questions to yourself and why you're buying this property, right? So that's step number one. Really, really dig down into why you want to buy something, and don't just kind of FOMO into it just because the prices are going to go up, right? Because everyone's situation is going to be very different, and you need to really figure out what your situation is and not kind of be peer pressured into buying a home, because it's a really big commitment. Because if all of a sudden it turns out you don't like it, you're going to have to get rid of it and you're going to lose money. So that's kind of why it's really important for you to understand why you, specifically you who is listening, my audience, is buying a home, right? So number three, we're going to get into kind of the financing and the cost of it, right? So the first thing you always have to ask when you're buying a first home is, what do I qualify for, right? Like the golden rule of thumb I generally use is like, if you're doing 20% down, you qualify for something about like 5 times whatever your income is, right? Assuming you have the 20% down. So an example is if you have $100,000 income, right? And you have the 20% down, then you can times 5 on your $100,000 income and you can buy something that's $500,000. That's a very loosey-goosey way of just putting it. But like, obviously kind of like you have any debts, kind of like car leases or car loans or any like student debt, that affects how much you can borrow. But in a very loosey-goosey way, it's just like 5 times your gross income. So that's kind of why it's very difficult for a lot of people to get into the market right now, because if you're just coming out, unless you're in a professional kind of situation where you're getting paid a good amount of money, like, you know, a developer or something, it's very hard for you to buy a home right away, even if you have the down payment, right? So that's why a lot of people, you really have to question, what is it exactly you're buying? Back to my second point earlier, right? So that it actually makes sense for you, because if you don't qualify for something and you stress yourself, does it actually make sense, right? And then when it comes down to financing, you got to ask yourself, where's the money coming from, right? So a lot of people have down payment, you have it saved, maybe your RSP, maybe your parents are granting you something, right? If you're lucky enough, or maybe you have like an inheritance from something, right? You have to know where your down payment comes from. And obviously I'm going to get into the first time home buyer incentive, that they can give you some money to buy something as well a little bit later. And then the other thing is like, where are you going to get your mortgage from, right? Traditionally, like, you know, if you go and bank with like say a TD or something, then you can always get a mortgage there with them. But there's also a lot of different options out there, right? Because when you're doing the whole 5 times rule for financing, you're actually under a stress test, right? That's why it's 5 times. But in reality, you can borrow more than that if you're not under the stress test. So you really got to know where your financings are. And I think one of the very common mistakes I find with first-time home buyers is maybe you've had a bank with you for your entire life and you're very comfortable banking with that bank, but it doesn't necessarily mean that bank is going to be where you should be getting your mortgage, because you need to find what mortgage product fits you. Maybe the rates are different, and kind of see if there's any wiggle room and who you want to work with. Because what I've noticed is the person who is at the teller and then they find someone in the branch to help with the mortgages, they generally are not the best mortgage specialist, right? So I can tell you, like, I bank with TD. I have not much. I have like a very little mortgages with TD. And even if I did, I generally try not to get one with them, right? And that's just because of the type of products that they have for what I need, right? So you need to understand where to get your money from in terms of financing, right? So a lot of people also think that I'm going to be talking about like kind of whether you go fixed or variable. I'm going to talk about that a little bit later, because in reality, you don't actually need to worry about that right now until you actually get the place, right? Because everyone kind of jumps the gun on this one. Like, there's no point in thinking about fixed or variable until you actually know what you're buying, right? Like, I'll give you the principles and the reasons on the thinking on that later, but I'm just going to save it for a little bit later. And then the other thing you really got to think about, like kind of briefly talked about earlier, is what's the most important thing for you in this mortgage product and the cost, right? Like, is it the interest rate so you can keep your costs down? Right? Because if that's what it is, then you can definitely go shopping around, because you have banks like HSBC or Tangerine or like Simply that will have lower rates, but sometimes they're just kind of like a pain in the butt to deal with, right? Kind of like if you ever have to go put money into HSBC, it's a huge pain. I think they have really bad working hours, and I'm not just not poop on them anymore because I just don't like them. But like, you have different places with like, prepayment and all that stuff. So you really have to kind of figure out what the product is for you. So it's not just rate, but you got to figure out what's important to you. And I would say 95% of the times it will be the interest rate. So the fourth thing is when you're kind of figuring out where to get which bank, what product, and you figure that out, you want to go and get this pre-approval letter. Now, it hasn't been a very common thing to have a pre-approval letter in a little while, like especially for investors. Like, you don't really get one, but I know some banks, if you go to like the retail side, which is like the branch, you show up at your bank, they will give you a letter, and it sometimes takes a long time to do, which is kind of pointless. Like, in my experience, if you're working with a mortgage broker, they'll just like, look, give me all your like income stuff, your pay stubs, your NOA, or like your proof of income, your credit score, and they'll have an idea of what you're able to do. And you don't really need the pre-approval letter. Like I find the pre-approval letter, while it still kind of exists in certain banks, right? It's more of a comfort thing for you to get, but it doesn't necessarily mean it's like a legal binding document. The whole idea of the pre-approval letter is like saying like, hey, Bob, right? You're qualified for $500,000 loosey-goosey, right? And we'll kind of, promise you at this interest rate, right? So you can kind of lock into interest rate. But it doesn't actually mean they're going to lend you the money, right? So the difference between a pre-approval letter and a commitment is that a commitment is when you sign the documents and it actually is the exact interest rate, the exact amount. Whereas a pre-approval letter is kind of like, hey, Bob, looks like you're going to borrow $500,000. That's cool. You can go buy something. Congratulations, right? Like there's no merit to it, right? And in the world of kind of a very seller's market, very competitive, like people used to attach pre-approval letters, and I'm like, I don't know why, right? As long as you show me you have the money, right? So that's why if you attach like a certified check to it, it actually looks better than a pre-approval letter. Granted, it can't hurt, but I wouldn't like go out of the way to get it because it's not going to make or break you getting it, right? But again, remember, it's not a commitment, it's just a pre-approval. If you feel more comfortable getting it because that's the type of personality you have, then yeah, definitely go get it, right? It just takes a little bit of time. That's all. Now, when it comes to working with mortgage brokers, I find they generally won't give you mortgage, a pre-approval letter, and they'll just tell you what you're good for, right? So that's why good mortgage brokers don't make mistakes on your calculations, are good to have in your corner so they don't botch the deal, right? Again, you can pick between mortgage brokers or like mortgage specialists who work specifically in the banks. And again, something I'm going to get into a little bit later because it's kind of a confusing thing. And I'll show you kind of what's the best way to do it. And there's pros and cons to both. Now, the idea of the pre-approval, like I was saying you earlier, is just really just to give you comfort. But at the end of the day, so we're talking about like pre-approval letters, right? You really just want to get into kind of the idea of what your maximum is so that you're comfortable with. Because in today's seller's market, it's very difficult to kind of navigate because everything's like listed under, and you need to know what your maximum qualify for, because you don't want to go over or you don't want to just max it out right away. You need to know what that limit is, and that's why working with someone that you trust and have a good sense of the calculations is going to be very key, right? So number 5. Now we're going to talk about whether you want to do 20% down or the minimum down. So traditionally, everyone, unless you kind of dug deep in this and you understand a lot of the real estate stuff, and this is why I'm going very, very like simple stuff, right? It's not for very complicated advanced stuff, which we'll probably get a little bit later. But the idea here is to kind of give you a very overarching idea of everything that needs to happen when you buy a first home. So a lot of people think you actually need minimum 20% down to buy something, right? So if you were buying something that's $500,000, $500,000, you need $100,000, which is 20% of that. But in reality, as a first-time home buyer, or if it's for your personal use, you actually don't need 20%. You can actually do less than that, right? So I'm going to kind of debate between which one makes a lot of sense for you, right? So if you do buy anything, right? So this is the first thing. If you buy anything that's over $999,999, which is a dollar under a million, so $999,999, then you're allowed to use less than 20% down. But the minute you get into 7 figures, right, you have to have 20% down. So say you're buying a condo in Toronto right now, if it's a 2-bedroom, yeah, you're still good to go for less than 20% down. But the minute you go to say like a semi-detached home in Toronto, which is like $1.3 million right now, you're minimum 20% down, right? So with that amount, it's a sliding scale on what it is. So when you how do I say this? The first $500,000 you buy, right, whatever it is, you're allowed to do 5% down, which is $25,000. But you'll be hard pressed to find anything that's under $500,000 right now, unless it's like, 200, 350 square feet studio in Toronto right now, or some really crappy areas of condos, which I don't recommend. So then you're allowed to do $25,000 on the first $500,000. But any increment after becomes a sliding scale, right? And it's a percentage of it. So give you an idea. If you do $999,999, the minimum down payment is actually 7.5%. So I tracked myself. Now I'm sharing a calculator on my screen for you. Again, if you guys are listening auto, it's okay. So you can see here, I'm using a purchase price of $600,000, and $600,000, your first 500 is 5%. But anything after that becomes a sliding scale. So in this case, if you buy something 600, the minimum amount you need is 5.83%, which is $35,000, right? But if you do 20%, it's $120,000. So this is why it's important, because a lot of people will try to get up to 20% And because, there are consequences of not having 20%. And this is what I'm going to go into. If you were to do 20%, you're able to have your mortgage, right? Your duration, like how long you have this mortgage for 30 years. Now in Canada, we have these things called terms, which is generally 5 or 10 years, meaning that at the end of those, you can go to a different bank to continue paying off your mortgage. But your mortgage is still generally 30 years. So when you do 20% down, it gives you the opportunity to make your mortgage 30 years. Whereas if you do less than 20% down, you have to do 25 years. And why this is important is if you think about it, if you owe somebody $100 and you have 10 years to pay them, you pay them $10 a year. Very simple math. But if you owe someone $100 and you have to pay them back in 5 years, you have to pay them $20 a year. So that means your yearly payment increases, which is the same thing in the mortgage. So if you do a 25% down, it means that your monthly less than 20% down, your monthly carrying cost is going to be higher. So you can see in this example here, if you buy $600,000 property and you do the 25% down, you're going to be looking at about $2,300 a month, right? Whereas if you actually did 20% down, you would be paying $1,772, which by my really quick live math is give or take $600. So that's a very important amount, because when you do have a shorter mortgage period, obviously the mortgage payment increases. The other thing that also contributes to this is depending on how much percentage you put down, there's a sliding scale on what we call mortgage insurance, right? And this is what a lot of people want to get up to 20% for, to avoid paying this, quote unquote interest that really goes into nowhere. And the reason why they have this is because this gets backstopped by CMHC. I'm not going to get into too much detail. And it allows them to kind of that's the banks to make sure they still lend to you, right? You got to get the mortgage insurance from CMHC or some other company similar like Genworth, or I think the new one's Canada something, that they change the name. And you have to build that into your mortgage cost. So in this example, you effectively adding $22,000 of interest into your mortgage payment that you have to pay off over 25 years. And while that sounds like a crazy amount, if you break that down into say 25 years, it's like $1,000 or less than $1,000 a year, right? That is some money, but I'm going to show you the pros and cons to it. Because when you go with an insured mortgage, right, which means you have less than 20% down because you have to get CMHC insurance, you are generally qualified for a lower interest rate. So if you remember earlier this year in February, where I think HSBC was coming at 0.99% interest rate for mortgages, it was on insured mortgages, meaning you had less than 20% down. So your interest rate, like I put, is probably less than 1.5, whereas traditionally it probably is 0.5% higher if you were to do something with 20% down. So there's pros and cons to this. The other thing I'm going to get into is that depending on where your down payment's coming from, like if you have it gifted to you and generally they give you the full 20%, so you're not paying interest, fantastic. This is irrelevant to you. But if you're someone who isn't lucky enough to have that down payment gifted to you, you have to look at this chart here, right? So I did this a few years ago to show you whether you should be saving up 20% to buy your first property, or should you just get in with the minimum down. And in this example, what I did is I took someone's average income of $60,000 and you had a saving rate of 10%, right? Meaning you save $6,000 a year. Now, granted, this is all before tax because I'm not going to get into that. But if the house price continues at the standard 6%. You can see this is the yellow line. I'm sorry you're listening on this audio, you can't see this. That's kind of like a consistent compounding rate of how much prices are going to go up. And if you were to save based on the house price for 5% down, because remember, when prices go up, your down payment also increases. At $60,000 a year and 10% saving, you're going to be able to hit that point when you're saving by yourself in about 5 years. Meaning in 5 years of saving, you can use the minimum down to buy something, right? And that's very important. Whereas if you were to actually save that amount and try to get to 20%, you can't actually ever cross the line, which is the red line right here, because the rate at which you're saving is not going fast enough to get to 20% at the rate in which the prices are increasing. So there is a benefit to paying the mortgage insurance and all that stuff because it allows you to get into the market faster. Because a lot of the times, especially some of the younger clients I have, they have really strong incomes, but the problem becomes they can't get the down payment quick enough, right? And that's the hardest thing because, not all of us are, gifted rich parents, as the joke goes right now, or your parents own real estate that they can borrow from. Now, I also illustrated this in a second one, where if you were a very aggressive saver, say you lived at home or something like that, you saved 20%, right? And if you were to do the 20%, you can reach that in 9 years, which is right here. Whereas if you do 20% savings, you can buy with minimum down at about year 2. And now keep in mind this, in this one, what we're buying is a $500,000 condo. I did this a few years ago. The entry condo right now is probably $600,000. So the idea here is if you do have less than 20% down to buy something, there's nothing wrong with it per se. Like, don't be afraid of the mortgage insurance because it allows you to get into the market sooner rather than later, because most of the time prices will outpace you. And if you get the benefit of having a lower interest rate for the term that you get, it's okay. It's kind of like a wash, right? Just get into the market. That's the key thing, right? You want to get into the market where you're going up and down with the market as opposed to constantly chasing it. That's why it's very, very important to get into the market. And I've been preaching that for a long time for a lot of first-time home buyers. But again, still coming back to point number 2, why do you want to get in the market? Make sure it makes sense. Just don't FOMO into it, okay? So I kind of talked about all the 20% down versus minimum down. And again, if you have the ability to kind of borrow the balance of it to get to 20% and get to 30-year mortgage, it's generally going to be better for you. But if you're just starting out and you're like your savings is at 0, yeah, you're definitely going to want to use a minimum down. Now, the government did come out with some other first-time home buyers incentives I'm going to get into that will add into this, but that's a couple points down the road. All right, so number 6. Oh my goodness. All right, this is going to be a really long one. All right. Number 6, the RRSP, right? So this is a retirement savings plan. Generally, I would say, I'm not going to go on a tangent. I don't believe in RRSP because I don't think it's going to fund it, but using RRSPs to buy your first home is very good. So the idea here is that basically if you are putting money into your RRSP, you're going to get some advantages because you can borrow $35,000 from that right now, which is the new cap. I think they increased it last year. Last year. So why this is of benefit to you is, say you're making $100,000, right? And you put $35,000 right away of your money that you earned into RSP. That $35,000 or 35% of the $100,000 is exempt from taxes, meaning you don't pay any taxes on it. Because if you've gone to your first job and you do like your T4 or I think it's T4, right? Like your pay stub and stuff. You'll notice that there's a CPP line, a federal income tax line, the provincial line, and maybe EI that subtracts from you, right? So that means your, $100,000 every month that you get paid is actually less than the amount because you get taxed. But when you put it into RSP, you don't get taxed and it's exempt from it. So the other benefit to that is when you put it away, when they take your money from your pay stub, it's taxed at the $100,000 rate. But if you put $35,000 away and you file your taxes, you're actually reporting $65,000, which is 100 minus 35, right? The balance of it, so 65% or $65,000. And now, because you're at $65,000, you're at a different tax bracket. So maybe instead of paying 30-something percent in tax, you're now paying like high 20s. So the difference in the tax you would have paid already, right? And because they take it off your pay stub right away, come tax season, you're going to get a refund. So it's important to get the $35,000 up there because it's not that it's going to affect the calculus in the way you buy your property, is that when you actually are saving up to it, you can save it faster because you're not paying taxes on it, right? So if you think about it this way, the $100,000, let's say you save all of it, you get $65,000 after tax and $35,000 before tax. So that's more money than if you were just to get $100,000 after tax. So that's why the RRSP is important. Now, for you to utilize it, you just have to make sure the money is in your RRSP 90 days before you close the property. So it doesn't have to be when you start searching. It's just whenever you close the property. So if you are closing a property in January 1st, 2022, then you want to be 90 days before that, right? Now, how you pay this off is you generally have 17 years. It's supposed to be 15, but you get the first 2 years as a grace period. So if you do the math, say $35,000, you max it out, you divide that by 15, you're generally paying like $2,100 back into the RSP every single year, right? So that's kind of how it works. It's powerful in that sense that you can, start saving money tax-free. But should you continue RSP, that's the story for a different day. The other thing that's quite beneficial is if you work in a company that contributes to your RSP, right? So you put $1 in, they match every dollar. So this way you can get up to the $35,000 even faster. But keep in mind, you will get capped out at $35,000. So if you have anything more than that, you can't actually use it and you have to use cash. And you don't want to take money out of your RSP because there's withholding taxes, right? But conversation for a whole different day. Number 7, first-time home buyer benefits, right? I'm just lumping them all in together. The main ones are your land transfer tax. So if you're buying something, it's a tax on the purchase. So the seller doesn't pay it. You as the first-time home buyer will be paying it. And whenever you buy a property, you're paying it regardless, right? So if you're buying something in Toronto, there's actually 2 land transfer tax. So we'll back up and talk about the provincial one. So if you're buying somewhere in, like, say, Durham, York region, Peel region, Halton, which is kind of like your Mississaugas, your Miltons, your Oakvilles, your Markhams, your Vaughns, your Richmond Hills, your Ajax, your Whitbys. Those are not considered Toronto. There's a boundary, right? And if you buy something there, you have to pay a sliding scale of your land transfer tax. So if you buy something in all of like the province, you're, as a first-time homebuyer, you automatically get $4,000 credited on your closing cost, right? So this is something I'm talking about later, which is called a statement of adjustments by your lawyer. But basically, that amount, the land transfer tax, gets tacked on to your closing cost, and you have to pay it before you close. It's mandated. So if you're a first-time homebuyer, they check a box, and in Ontario, you get automatically $4,000 if it's, I think, over $400,000 or $450,000, which is like almost every property at this point. So you automatically get $4,000 back. Now, if you buy something in Toronto, like downtown Toronto, I think the boundaries are South of Steeles, I think between 427 and the other one is, I think, I want to say it's like Port Union on the east side. So if you're within that boundary, you need to pay a second land transfer tax. And it's roughly the same thing. It's usually doubled, but the city land transfer tax for Toronto is, the rebate is $4,450, I think. So if you buy something in Toronto, and it's, again, anything over like $450,000, which is generally every property at this point, you're going to get a total of $8,400, give or take, right? $4,000 from the provincial and $4,400 from the city. If you buy in the suburbs, right, so the 905, then you get a $4,000 rebate. And those are the land transfer tax. So those are the biggest ones, being a first-time homebuyer. Now, a lot of people will say that if you buy a rental property, that's technically not your first home to kind of like live in, so you may be exempt from it. Again, talk to your lawyer on how you want to navigate. Some people just say it is, and then they change their mind. But do with it your own kind of thinking. I know a lot of people I've worked with will say it's a first home and they rent it out afterwards, right? So that's your decision. Now, there's another thing called the first-time homebuyer tax credit. I think this is just a bunch of baloney. I'm not going to go on a rant on it, but like they tell you that it's a $5,000 benefit. But at the end of the day, when you do your taxes, kind of like your RSP, it's not $5,000 like credit or like a rebate. It comes down to like $750 refund. So while it's not the end of the world, you will get $750 back when you do your taxes. You just got to check the box that you just bought a first home. Right. So we got number 8. Which is your home buyer's incentive. And I'm going to lump in a couple of changes with this because when this came out, there were some other changes that the federal, one of the government levels have done, right? So with the home buyer incentive, this is kind of where the government chips in to give you a little bit of like a boost with the down payment. They kind of lend it to you. And if you buy a resale property, like an existing one, it's 5%. If you buy pre-construction, it's up to 10%. They'll lend that to you. Now, here's the catch, right? When you sell the property, whenever you sell it, you have to pay them back a percentage of whatever it is they gave you. So if it's a resale, you have to pay them back 5% of whatever you sold your property for. Or if it's pre-con, you have to pay them back 10% of whatever you sold your pre-con for. Or whichever runs out first, you sell it, or after 25 years, you have to pay them back. And it's a percentage. So if you say for simple math, right, you buy something for $1 million, they lend you 5%, that's $50,000, which is fantastic. But if you sell your property for $2 million, then you have to give them back 100,000, 50 times 2, right? So you're going to need to do that. Now, I personally don't like it, and I've spoken to a lot of mortgage brokers that a lot of people don't use it because nobody wants the government in their owning a piece of their property, right? But that's kind of the weird thing. And on top of that, there's a lot of weird things for you to qualify for, right? So I know they just tweaked it, which is why I'm lumping a lot of these new changes into this number 8. If you're in Toronto, Vancouver, or Victoria, which is the more expensive parts of the country, so this is probably a federal thing. You can't borrow more than 4.5 times your income, and you can't make more than $150,000. Now, if you're outside of the bigger cities, right, so like say Calgary or Montreal, you can't borrow 4 times your income and you can't be higher than 120,000. So it really kind of pigeonholes you into what you're able to use it for. And that's why no one's kind of used it and why I think it's just, political pandering. But again, topic for a different day. So like if you're able to technically borrow 5 times your income, but you can't exceed 150,000 in income, so 150 times 5 puts at 750. So you can't actually buy anything more than say $750,000 in Toronto if you have less than $150,000 income. That means you're kind of strapped to call it a 1-bedroom plus den with parking or a really small 2-bedroom, which is kind of not ideal if you're kind of making that kind of money. So that's what I'm saying. Like it doesn't make any sense to have this out there, but it is out there. And I don't like using this program. I generally don't recommend it. And you can talk to a mortgage broker about it. But where one instance it actually does make sense is if you have $0 saving, kind of like what I was talking about in the previous minimum down payment. If you kind of tell them to give you 5% and you can get into the market into say something that's $500,000 and you make 100 grand, you can get into the market really, really quickly and you just pay them back that amount, right? So there's benefits in that sense. But if you kind of have like say a little bit of money down and then they top you off another 5%, that doesn't make any sense. And I'm going to show you why. So if you were to buy something, back in my example of $600,000 here, if you had the 5% down, which is $35,000, your mortgage payment's $2,350, right? And if you get the government to give you another 5% on the purchase, which will top you up to 10.83%, or like, a little bit short of about $65,000. That doesn't make sense. They'll give you 5%. Oh yeah, 5%. Yeah, you're right. Okay. Yeah, so it gives you up to $65,000. It changes your mortgage payment to $2,200, which a difference is $150. Now, if $150 is going to make or break you, you may really want to consider not buying a property, right? Which just comes back to my first point, or point number 2. Why are you buying this? Because just because you're saving $150 a month, now the government officially owns 5% of your property. So when you sell it in the future, you're kind of paying them, they're paying you interest, call out $150 a month. But when you sell it, say this property becomes worth $800,000, you're gonna have to give up 5% of that back to them and you get less profits, especially because it's a primary home. You don't have capital gains on this. Knock on wood, don't change that, right? That's why I say this doesn't make sense. It only really makes sense if you're going from 0 to 5 and then they can top you off, right? So I would do it in that sense. Now, one of the other things that they did here and they've kind of proposed when all this stuff was kind of coming out was, I was talking about, your minimum down payment of 20% if it's over $1 million. I know since the last federal election, which happened in 2021 in September, there's a lot of talks about the government actually increasing that minimum amount to 1.25, meaning that you can use less than 20% down at the purchase price of 1.25 mil. So if and when that passes, if you're listening to this at this time, then that number changes. And ultimately what's it going to do is going to put more demand onto the entry level stuff and the prices will go up. So that's why I didn't really talk about it in the beginning and lumped into this one, but that is potentially coming down the pipeline. So if you're trying to get into say like a 1.2 mil home, which could be like right now or maybe in the future, like a townhome in the 905, yeah, you can definitely do it with less than 5% down, right? If that stuff changes. All right, number 9. So this one is a very common one I get. In your first home, should I buy pre-con versus resale, right? I'm going to say 95% of the time you should go resale. And for one reason only. Life changes and you never know what's going to happen. And you don't want to be having your life circling around a pre-construction home. So let me give you an example. If you have the money to buy something right now, you're better off buying it so you can go and live in it in the next like 30 to 90 days because that's how long it takes to close. But if you're thinking about buying your first home and say like, you're in your late 20s, you come to some money, your career is flourishing, then you can definitely go buy something, right? But if you were to kind of say want to buy a pre-con because you like something newer, then you may have to wait like 3 to 6 years for it to happen, and you won't know where you are in 3 to 6 years, and you're always going to be perpetually kind of waiting for it. Because even though they say the occupancy is say an X date, there's always delays. Like only once in my lifetime have I seen a builder be on time and close the entire building all at once and when they promised. So very, 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 very rarely are you going to actually have the product ready when they say it is, and life will change. So that's why I'm saying resale makes a lot more sense. Now, the instances where pre-con does make sense is say you're very, very young, you're living at home, and you don't have the full 20% down, or you don't have like 5% down or something, right? And you're slowly starting to build up your career. Yeah, you can definitely put your money into a pre-con as your first home, right? And becomes an investment. And as you make more money, you can start feeding into the deposits, right? But if you need a place to live, right, and you're kind of like renting right now, it doesn't really make any sense, because then you'll always be renting until that place is ready, and you're also going to be continually waiting for the rent, assuming you don't get kicked out if someone buys the place, right? Then you're at a lot of mercy of your landlord. Then you have to find another place, you have to move again. And that's why pre-con doesn't really make sense. Now, if you're talking about pre-con in a house, I've experienced this for myself personally. The idea of something new is great, and the wait periods aren't that long. Generally, you can build a house in like 1 or 2 years, depending on any kind of supply chain bottlenecks. But the new is not that great. It really is not that new. I find that if you actually know how to do renovations, you will do a better job than most of the builder finishes. And if you want any of the builder finishes, they tend to be really expensive as well, right? So Like if you're buying pre-con, I generally tell people you should get light fixtures, especially in a condo. But if you were to do it in a house and you go get light fixtures from a builder, it's like $200 a pot light, whereas you can do it yourself for like $80, right? So you're paying a major premium on pre-construction in terms of the finishes and upgrades and the fact that it's new. But at the same time, you're not necessarily getting any more value out of it other than the fact that it's new, which I'm going to discount a little bit because new is still not that great because there's a lot of like defects and then there's tear on and all that stuff. And while tear on makes you feel good, if you ever go up the ladder of trying to get stuff done in tear on, they're generally in the favor of the builders, I find, right? I have lots of stories of that. I'm not going to get into it, but this is just kind of my first-hand experience and my experience from clients. So if you're looking for your first home, right, I generally say do resale. There's just more value in it as well, because if you do pre-con, whatever the deposit structure is, you're going to have all that money ready. Whereas like with resale, you still can do the minimum down, right? So if you're like in the $1 million, you can do like 7.5% down. Whereas with pre-con, you're probably up to at least minimum 15% or 20% paid up already, right? So you kind of lose that advantage. Number 10. This is your living situation, right? So, tackling back to my last point, number 9, it's like pre-con versus resale. You have to understand what your living situation is. So let me give you an example. If you're currently renting right now, make sure you're on what we call month-to-month lease, right? So a lot of people actually don't know this, but if you're on a month-to-month lease, meaning that like say you signed on in January 1st in 2020, and then 1 year has ended, which is December 31st, 2021, right? You don't have to sign a new lease to continue staying there, right? It has implied that you're going to go on a month-to-month basis. Now, the reason why a lot of people don't talk about this is just because like the landlord-tenant rules are kind of fuzzy out there, even with like the landlords I work with. But as a tenant, it's best to not renew another lease because when you do renew another lease, you lose the ability to leave right away. So if you're on a month-to-month, as long as you give 60-day notice or you have like mutually agreed with your landlord that you're going to leave at some point, you have that flexibility to be buying something and be flexible to sellers to win in competition. So let me give you an example. So say you're month-to-month right now and you're looking for a place, and at the very least, what you can do is say, hey, I can close in 60 days, and then you can give your landlord notice so that you're lining up the seller's preferred closing date with the kind of something that works for you. Right? Or if they want to close in 30 days, which is very common if it's like empty property, then at the very least you're only having an overlap of mortgage and rent for 1 month. Whereas if you sign a lease, right, you have to honor it until the end unless you and the landlord mutually agree to kind of end it. And that's kind of why you need to know what your living situation is. Now, if you're thinking about buying in the near future, obviously you want to stay month to month. But if you're not going to buy for at least a year, and this is just a tip for tenants out there, you probably want to sign a lease, because what happens is on the off chance your landlord decides to sell, if you have a lease in place, the new buyers have to honor that lease. So like say you renew your lease from January 1st, 2021 to 2022, whoever buys it between that time can't kick you out. They can't, because they have to honor the lease. It's in place, right? But if you don't sign it, as long as the new buyers tell you that they're going to move in for personal use, then they'll give you 60-day notice and you're out. So those are kind of the living situation you have to understand when you're looking at your place. Now, if you're living at home, then you have the maximum flexibility depending on your situation. Like you could leave whenever, you can just leave your stuff there. So that's the maximum flexibility I find. And anyone who's in that kind of living at home situation, you have the best ability to kind of do renovations, which I'll talk about a little bit after. But because like you're not carrying multiple, but like if you're trying to do renovations and you are doing month to month, there's some risk in that. It's a very rare occasion, but it's just something to keep in mind. Right. So number 11, this is going to be the start of the search, right? So, if you had infinite money, you can get everything you want, right? Everything. But the challenge is in a very competitive market, you have to pick between what you want. And what I always mean by that is like you have to pick what is a need and what is a want, right? So if you have a car and say you visit your parents every single weekend or every other weekend in the 905 and you need to drive to go see them, right, because the subway doesn't go that far yet, then you definitely need a parking spot. But if you are saying that, hey, I'm going to be here for 3 to 5 years and I think I'm going to buy a car in the future, I want a parking spot for something in the future. It's not a need. So you don't want to be paying extra for that because the parking spots can run you like $80,000, $90,000 and you have to pay maintenance on it, right? So that's an example. The other thing is like some people have a very high preference of like a full-size kitchen, right? So that is a need. But some people don't cook, but they just want a nice kitchen to entertain. That's a want, right? Or another one is like, I'm buying a condo downtown because that's a need. Buying a condo downtown because I want a good view. That becomes a need because there's a personal thing, but it doesn't necessarily become a want. And you have to see what's important to you, because if you want a great view, obviously comes with a price, right? Now, if we're talking about homes, most people that getting into homes, like generally they're starting a family or something, or they think about it in the near future, and you don't want to be moving homes too often because the transaction cost high. Then if you're thinking about your kids, then a good public school, meaning from JK to 6 or 8, then that becomes a need, and you're probably paying a premium for it because good school districts tend to have more expensive homes, right? So you have to understand when you're looking the difference between a need and a want. If you had infinite money, you can want everything and you can get it. But if you don't, you really have to pick the difference between needs and wants, right? And one of the biggest things I always say is your needs generally tend to be space because you can't change it, which becomes your lot or the condo, the square footage, or the view. But your want, or your views, but your want, kind of like you want a nicer kitchen, you can always do that in renovation, right, down the road. So there's a difference between a need and a want. Now, when it comes to searching, because you don't have infinite money, I'm just assuming that, like I'm just like a multi-billionaire, right? You have to have compromises, and you compromise on like location, finishes, or kind of like the amenities or school district. You have to find those compromises and make it work. And you kind of will realize that, during your search when you're kind of moving around in the market and putting offers in. That's kind of what our role as a realtor is kind of doing, right? And what I will say is, it's going to suck during your search, especially in this seller's market where, you're competing with 5 offers and people are doing bully offers. Just don't give up. It's going to suck losing in competition, but every first-time home buyer goes through the same thing because every first-time home buyer generally is looking for this very similar product, right? The reason why I'm making this video is to help all the first-time home buyers out there kind of navigate a lot of this. But, we help a lot of first-time home buyers out there. So if you want us to help you and represent you in your search, you can definitely reach out to me using the link here, which is www.chatwithzen.com. Oh, I forgot. Also, make sure you like this video and subscribe to the part of the channel because we put out content like this to basically be transparent and honest so that, like I was saying earlier, you're going to basically be like, oh yeah, you know what? Zen, he knows what he's talking about. He went through all this with a lot of his clients and he's very thorough in all the things. And he's even showing me all the things I didn't know what to expect when first time buyer. And you know what? I want to work with them to help them find their place, right? So that's why that's kind of our business model. All this content out there is to be transparent and honest with you so that you understand kind of what's to come because let's be real. I think a week ago or two, there was a whole bunch of like negative press about realtors and CBC marketplace. That stuff is real, right? That stuff is definitely real. But obviously there's going to be, the bad apples and the good apples. And we want to be the good ones so that if you want to work with us, again, use the link on the screen right now. It's www.chatwithzen.com. Because you know what? Like a lot of this stuff, a lot of clients, when they come to us for investing, they're like, man, we wish we found you for the first time home buyer as well because you have more grasp of this, right? So again, that's kind of what we put there. Make sure you like and subscribe to the channel too, okay? All right, so during my editing process, I realized this was way too long. So I'm breaking up this podcast into 2 parts, but I will release it wherever I left it off. There is a part 2 that's coming, so make sure you stay tuned for that and you can check that out. Now, if you guys have halfway through, do have any kind of questions in regards to buying your first home, or you have any comments about this type of format, or you're just kind of looking for help, again, you can use the link on the screen right now to book a call with me. It's www.chatwithzen.com. And again, we do this for a lot of our clients because, look, we put a lot of information out there so that you know what's going on because this is probably something you've thought of, maybe it's something you didn't think of, and because there's a lot of things we guide our clients through when it comes to buying their first home. So hopefully you found this helpul, and until next time, your move, your future. See ya.